At 3:15 p.m. on August 3rd, thousands of Indian day traders realized their risk management had failed. Across the country, perfectly valid pending limit and stop-loss orders had suddenly vanished from order books. This replaced a decades-old unified system where every segment of the market reliably locked its doors at exactly 3:30 p.m. On that first day, August 3rd, the transition was immediate and messy. Discount broker systems desynchronized, triggering a massive wave of forced selling as automated platforms scrambled to liquidate open positions ahead of the new deadlines. SEBI designed this shift as a deliberate, calculated regulatory intervention. In coordination with the National Stock Exchange, the regulator began the process of dismantling the traditional market close. Understanding why the authorities chose to break a functioning system requires looking at the specific pricing vulnerabilities they were trying to solve. This chart illustrates the primary vulnerability of the old system. Institutional players could execute massive orders in the final minutes of the unified session to manipulate the closing price, creating the vertical spike seen here. To counter this, SEBI replaced the hard close with a staggered closing auction designed to average out these late session orders. At 3:05 p.m., brokers moved internal warning alerts forward. By 3:10 p.m., auto square-offs began, concentrating sell orders and creating intense downward pressure. Then, at 3:15 p.m., the market splits. Cash stocks in futures and options halt entirely to enter the closing auction session. During this new auction, the exchange matches orders to establish a weighted closing price, effectively neutralizing the last-second manipulation tactics used in the old system. While regulators achieved their goal of price stability, retail traders on day one were caught off guard. Because normal trading had stopped, their pending stop-loss orders were automatically canceled by the exchange as the auction began. The attempt to engineer a fairer closing price resulted in many intraday traders losing their primary safety net exactly when they needed it most. This immediately created a significant logical gap. Between 3:15 and 3:35 p.m., the cash market is frozen in its auction, while the futures and options market continues trading at full speed. During this data blackout, the top cash stream freezes, causing the F&O stream below to lose its real-time reference. Charting platforms lagged, distorting fair value calculations. Without this anchor, option premiums swung wildly as traders struggled in a data vacuum. At 3:30 p.m., stocks not linked to the F&O segment reached their final bell, maintaining the original market schedule. The final endpoint arrives at 3:40 p.m., which is now the definitive close for all futures and options trading. By stretching the closing process across multiple segments, the predictable 3:30 finish line has been replaced by a 35-minute sequence of distinct operational windows. Despite the initial friction in India, these changes align the market with the systems used by major global exchanges. The London Stock Exchange has long used staggered closing auctions to prevent the same type of price manipulation SEBI is now targeting. Similarly, the Hong Kong Exchange utilizes a fragmented closing model to ensure a fair, volume-weighted final price for institutional and retail participants alike. Navigating the new close requires setting intraday alarms earlier and strictly respecting the 3:10 p.m. auto square-off threshold used by most brokers. Additionally, the final 5-minute window from 3:35 to 3:40 p.m. should be utilized primarily for managing hedges rather than initiating new directional trades. SEBI redesigned the market clock to prioritize systemic stability, which now requires traders to recalibrate their end-of-day strategies. To stay updated on these shifts, subscribe to the channel and join our WhatsApp community for daily market insights.